I think the 4-year cycle is broken. The basis of the 4-year cycle was the 4-year halving. And the first 12 years, you know, in the first 4 years, half of all the Bitcoin that will ever be created was created in the first 4 years. And so you can see that there was a big 4-year cycle, because after 4 years, the amount of Bitcoin being produced every cycle was cut in half. And we created 25% of the Bitcoin in the next 4 years, and then 12%. So we were really driven by the supply side for the first 12 to 16 years. At this point, the amount of Bitcoin that's being produced is becoming a small fraction of the amount that's being traded. In 2 years, we'll be down to 200 Bitcoin being produced. And so at that point, you know, you're talking about 1% or 0.1% of the daily trading volume. And so really the price action right now is not so much being driven by the supply side, it's driven by the demand side. And that means the formation of bank credit. Banks could issue $100 billion of credit on Bitcoin in the next 12 months. That would be 10x the supply.
Bitcoin's most famous playbook just got thrown out. For over a decade, the 4-year halving cycle was gospel. You bought the dip, you waited, you got paid. Every serious Bitcoin investor had that framework baked into how they think about timing, entries, and exits. Michael Saylor just said it's broken. And his argument isn't emotional, it's mathematical. Here's the core of what he's saying. The halving cycle worked because supply was the dominant force in Bitcoin's price. In the early years, half of all Bitcoin ever created hit the market in the first 4 years, then another 25%, then 12%. The supply shock was real, and price followed it like clockwork. But that era is over. Miners are now producing around 450 Bitcoin a day. At today's prices, that's roughly $10 to $11 billion per year of new supply hitting the market. Strategy alone has already bought $11 billion worth of Bitcoin in the first half of this year. Just one company, absorbing more than the miners can produce. And then Saylor drops the number that reframes everything. STRC, Strategy's digital credit instrument, is currently running at a $24 billion annual issuance rate. That single product is soaking up 2 to 3 times the entire annual miner output by itself. So the question is no longer when the next halving happens. The question is how much new demand is about to enter this market. Banks, ETF flows, institutional credit, regulatory adoption. Each of those is potentially worth $10 to $100 billion of new capital pressure on a fixed supply. Saylor makes it clear, there's no more supply problem to solve. The supply is essentially gone. What happens next is entirely a function of demand.
Well, the miners produce about 450 Bitcoin a day. That works out to, say, $10 to $11 billion a year.
Right.
We bought $11 billion of Bitcoin so far this year, and we're not even halfway through the year. So we're already buying at 2x the rate at which they're able to produce it. The digital credit business, STRC, has been an explosive success. It's gone from 0 to $10.5 billion outstanding in 10 months. But we sold about $2 billion of that credit in May, which means we're at a $24 billion run rate. So just that one instrument alone is going to account for 2 to 3x the Bitcoin supply that's produced by the miners.
But how does that work from supply-demand type of dynamics? I mean, if you're absorbing everything that's being produced right now, if you're looking to buy Bitcoin, then you're looking to buy it within what is in circulation away from what is being produced as well.
Yeah, once we've bought all the Bitcoin available by a natural seller, the price has got to actually move up to find a willing seller. So the way to think of it is there's a consistent bid that covers all of the natural organic sellers. And once that happens, every single time $10 billion of capital flows into this marketplace, that's 1 year's supply or one turn on the axle. So, you know, $10 billion or more may flow into the ETFs like IBIT. That's one source of demand. Banks are creating credit. So when a bank issues or creates $10 billion of credit against Bitcoin, that's another year's supply. Other companies like Strive are selling credit instruments like SATA. That's creating demand. And of course, our company is creating massive amounts of demand. All of those things are just turning the axle, powering up the network, driving up the price. And they have an effect of damping the volatility. One of the reasons, if you go back about 4 years, we traded down 75% peak to trough. And this time, the drawdown wasn't nearly as bad, and the reason why is because there's another source of demand that's consistent every day.
Right. I mean, there's a view that Bitcoin is becoming increasingly dependent on you actually buying Bitcoin. I mean, as broader investment demand, particularly from retail trading slows, and also because of the miners selling Bitcoin, as you've mentioned, to kind of fund the AI infrastructure build out. Is that true? And is there a risk of that being dependent on you so much?
I wouldn't use the word dependent. I would say we have become a material player in the space. 5 years ago, we were not a material player. Now we are generating $10, $20 billion of demand a year or more, so that's significant. But also the ETFs like BlackRock are very, very material and significant. The other Bitcoin companies are also significant. And really, the elephant in the room, the really big players with the big capital are the big banks. You know, JP Morgan, Morgan Stanley, Schwab, Merrill Lynch, BNY Mellon, Wells Fargo. They're all, to one extent or another, coming into this space, creating credit, beginning to custody and trade this asset. And any one of them can be as big or bigger than we are. And all of it's bullish because no matter how many people are in the space, there's only going to be about $10 billion of organic supply at this price level. So logically, the price has got to move up as adoption increases and interest expands. I think the tightening monetary policy is a headwind. I think the hot wars are a headwind. I think trade tensions are a headwind. The tailwinds will come from a variety of other areas. The regulatory adoption, like the passage of the Clarity Act, the issuance of the innovation exemption for tokenizing digital assets and tokenizing securities coming out of the SEC, the formation of bank credit, like Schwab extending credit on Bitcoin, other banks extending credit on Bitcoin, that's a big tailwind. And then the explosive growth in the digital credit market, markets like STRC, which are taking up 2 to 3x the natural supply of Bitcoin this year, and just all by themselves.
I do want to talk about the broader crypto industry type of tailwinds and developments we've seen in the last 6 months, and also STRC. But one recent change, as far as your strategy is concerned, that's getting a lot of attention right now, I heard you talking about this morning as well, saying you would never sell BTC, to now the potential that you could sell it. Would you sell or not?
Yeah, I think never selling Bitcoin is a good admonition for a retail investor and a hodler. Someone ought to just hold it for life, and it ought to be the thing you hold for a decade. We're a public company, so our objective is to maximize Bitcoin per share over the next, say, 7 years, like a long-term Bitcoin per share. The way we do that is by dynamically allocating capital. We have a dynamic capital allocation model, and on any given day, we can utilize cash, we can sell BTC, we can sell equity, MSTR, we can sell credit like STRC. And normally our decision of which of those things we're selling or what we're swapping is a function of the Bitcoin price, the equity price, the credit price, and capital markets forward interest curves.
Here's what you just watched. A man who controls 840,000 Bitcoin, roughly 4% of everything that will ever exist, just told you the game has changed. The halving cycle ran this market for over a decade because supply was the story. It's not the story anymore. From here on out, every major price move in Bitcoin will be driven by one thing: how much new capital is entering this market and how fast. Saylor's current pace is $11 billion this year. STRC is running at $24 billion annualized. That's before the big banks move, before JP Morgan, Morgan Stanley, Wells Fargo, and BNY Mellon have written a single serious check in this market. Any one of those institutions, once they come in at scale, represents a demand event larger than what strategy has done in 5 years. And there are only about $10 billion worth of Bitcoin changing hands organically at this price level per year. You do that math. The counter-argument is real. Strategy is not a guaranteed floor. If credit markets tighten, if Bitcoin drops hard enough for long enough, the STRC structure gets tested. Saylor is clear-eyed about the risks. Bitcoin going to zero breaks everything. If you think this asset goes to zero, don't touch any of it. But if you think Bitcoin holds, and you think institutional adoption is early, the supply argument is as clean as any in this market. There is no more supply. The question is how much demand is coming. If this video helped you think about Bitcoin differently, subscribe. New breakdowns every week. No noise.